Hypergrowth, accident and panic. The three constant horsemen of the financial apocalypse arrived in the United States in 1929. The automotive industry and construction drove the economy during the turbulent 1920s. Jobs, stability, social guarantees, consumption growth. Ford produced 9,000 Model T cars a day, and the cost of building new homes reached $5 billion. The banking system also looked healthy. 25,000 creditors kept $60 billion in the banks. The money was distributed reasonably. 60% were loans, 50% were cash, and 20% were investment securities. When the first signs of an overproduction crisis appeared, US stock markets continued to stimulate the growth of the value of the shares. It was particularly popular to invest in technology innovations, firms that worked with radio, aluminum, and airplanes. Although these companies usually had no real history of paying dividends, investors put money expecting further growth. The Prosperity Festival ended in October 1929. Stock prices fell unexpectedly. Depositors traditionally reacted with panic and tried to return the money urgently. In just 2 days, on October 28th and 29th, the Dow Jones Index lost almost 25%. Until the 13th of November, it fell by 45% in 2 months. Over the next 3 years, the market lost almost 90% of its value. The Great Depression began. Millions of Americans lost their jobs. And because of the huge unemployment, the famine began. Bank failures were in waves. Only during the first period in 1930 to 1931, 350 banks went bankrupt. The crisis swept through the capitalist world in a destructive wave. From 1929 to 1932, the world economy decreased by about 15%. The Depression lasted 10 years and ended only in 1939 with the outbreak of the Second World War. During the crisis, officials tried to revive the system with a massive injection of state capital. $1 billion, a third of the system's existing capital, was provided by more than 6,000 of the 14,000 banks that managed to survive. The Glass-Steagall legislation distinguished between stock market operations and household lending. The Federal Deposit Insurance Corporation, the FDIC, was created to guarantee the return of deposits in the amount of $2,500 and reduce the risks of bank failures in the future. This tool helped to reduce the panic mood among investors. And it became a revolution. Banks took the opportunity to advertise new state-insured deposits, and customers began to consider investments risk-free. Banks no longer insure their own risks, instead sharing them with the state. This stabilized the financial system for the next 70 years.